So we've seen Bitcoin drop into the high 70Ks this week, and that's brought in a lot of panic and fear. A lot of people are now calling for lower price targets, including myself, with targets being somewhere between 70 to 75K. Now, what I want to talk about in this video is the likelihood of us dropping straight down into that target as opposed to potentially heading up first before we head down. And the reason that I want to talk about that is because earlier this week, it was my thought that we're probably just going to go straight down. I'm starting to change my mind as the price develops, and that's what I want to talk to you about today. Now, before I get into that, I want to explain something to you that is really, really important for you to know when you are trying to be a trader or an investor in the crypto market. And I'm going to talk to you in this video about the financial players. And the reason that I want to do that is because it's watching these financial players that has led to me changing my mind and being open to something else happening in the short term. Now, long term, I do at this point still have the same target. So I want to be clear about that. And that target might take a few months to play out. I'm not 100% sure. If I happen to change my mind on that target, I will update you then. But this video is more about the short-term play of what I think might happen before we get to that target. And that comes down to understanding the financial players. So let me explain them to you. In the market, there are four main financial players. Number one is the decision maker. It's who the market makers get their orders from. Number two is the market maker. They are the entities that provide the liquidity to the market. Number three is the exchanges, which a lot of people think that the exchanges cause manipulation. No, the exchanges are just the transaction facilitators between the market maker and the retail trader, which is number four, which is you and I. So whenever you and I are trading, we are trading against the market maker. If we're opening a long position, they get filled by all the other short positions that are in the market, and whatever is left over has to be facilitated by the market maker. Also, when you open a leverage position, that position will be made up of margin, which is your money on the trade, and the rest of that position is borrowed money. Now, that borrowed money comes from the market maker, and the exchange's job is to put in a liquidation point to make sure that if that trade goes the wrong way and you go into a loss, the only money you can lose is the margin on the trade, which is your money. The exchanges won't let you lose the market maker's money, the money that you borrowed. So the market maker's job is to entice you, the retail trader, to come to the market and open a position. Why do they want to do that? Because unless you open a position, there's no liquidity for them to be able to open their positions against us. So the job of the market maker is always to try to induce us into a position. They can do this by one of three ways. One way they can do that is by creating wide range swings. And you'll find that in those wide range swings, there'll be stop hunts to the upside and the downside. Another way they can do it is by issuing just a fast move just out of nowhere in whatever direction. And you've probably seen that a lot, because that causes FOMO, especially if you're not in a trade when that happens. And so especially whilst you're learning to trade, you'll see the price move fast and you might think, oh, it's never going to come back. I'm not going to get in. I'm too late. And you just bang, go and commit money to the market. And that's how they've induced you to open a position. And the third way they can do it, probably this one has happened to you a lot, because it happens to all of us a lot until we learn exactly what I'm teaching you in this video. The third one is they can issue fast spikes in a direction to hit stop losses. And so if you've ever been in a trade where you got stopped out because it hit your stop loss, then the trade went your way and you're often like, oh, I was right, but it hit my stop loss first. That was intentional. And so you've got to really learn about where to properly position your stop losses so that stops happening to you. And so the reason that I'm telling you all of that is because usually when you have a big move like we've recently just had with Bitcoin, what can happen after that big move is for a few days we might just go sideways, which is what we're seeing now. Now it's in this sideways price action that people who understand everything I've just taught you will watch small timeframes very closely to get an idea of which way they're trying to induce retail to open positions. And it doesn't just come down to the price action. It can also come down to sentiment, which is a really big factor. So right now, the market maker will be holding price in a sideways range whilst they're trying to figure out just how fearful retail traders are, or are they willing to buy the dips? Because whichever decision we make, they're going to try to induce us to open more positions in that direction before they eventually make their big move. And so one thing we can do is we can look at the fear and greed, because that's going to give us a really good idea as to like how people are feeling. So when we look at the crypto fear and greed, it's at 27. It's in the fear range, but it's not extreme fear. So fear alone isn't enough, but it just gives you a little bit of an idea of how people, retail traders, are feeling about the market right now. When we have a look at the stock market fear, that's in extreme fear. Okay, so this is a little bit more important right now because it's not just a crypto correction that we're going through. We're going through an entire stock market correction. When we have a look at the S&P, you can see that we are in a pretty heavy correction right now. And of course, that's going to affect crypto as well. Investors are panicking right now because we've got Trump saying he won't rule out a recession. And we've got Trump also saying that the stock market's not his main concern right now. So this is, of course, worrying investors. And if the stock market is correcting, then crypto doesn't really have a chance against that. But it is likely that once this correction is over, crypto's probably going to bounce back before the stock market does. And that's because if crypto front runs the correction, which it did in this case, then it will probably front run the recovery as well. But here's the problem. If we were to believe that we're just going to keep heading down from here and our Bitcoin target is down in the 72.5 kind of range, then we also have to make sure that there is liquidity down there for that to happen. If there isn't enough liquidity down there, then it's likely they'll drive the price up before down because they will induce long traders. And by inducing long traders, by having a fast move out to the upside, that will then bring in liquidation levels below price that will allow them the liquidity to eventually take it down. And so the reason why I'm starting to consider this scenario is because we've been in this range now for a few days and we don't really have a strong commitment of buyers. So if people aren't feeling bullish enough to buy the dip right now, then it's probably because they believe we're coming down. Now, would the market maker make it that easy for you? Not really. If they need liquidity below price in order to send it there and the liquidity is not there right now, they will push it up before they push it back down. So that means we have to go and have a look at the liquidity. When we have a look at the heat maps for Bitcoin, we're in the green range here at around the 75K region. It's about 75 to about 76.5. That's this zone right here. Now, the green doesn't signify super high liquidity. It's kind of an average range. When we see yellows, like you can see how it was yellow here previously and price came down and took that out. That's the kind of liquidity that the market maker is looking for when they want to make a big move, which is the big move that we just recently saw. We can also see there's still a ton of liquidity up here at 115K. So that means that people who open shorts at the range high are still in their short positions. And that means if the market maker was to send price down immediately, like from where price is right now, those people win. So the market maker is not really wiping out much liquidity because there aren't many people opening long positions. When we zoom out and have a look at the CVD across multiple things, over the last couple of days here, as the price was dropping, all of the CVD on coin margin contracts was dropping, stable coin contracts was dropping, spot was dropping, and the open interest was kind of staying flat. So that's people closing positions, not getting liquidated. Now what you can see, only just today, you've got this sharp drop down here, and that's as the price is starting to move up today on a very small time frame. That's liquidations, right? And if you have a look at Bitcoin on a very small time frame, you'll see that today we've started, it's very weak, So I'm not saying this is the start of a trend, but we've had a move to the upside today. Now it is Friday and there are false moves on Friday to trap people into the weekend. So really I don't trust Friday price action, but it's serving the purpose of liquidating people, because liquidating people is how the market maker builds their contracts. And you can see when we zoom out on the whole week, since we hit that low, all we've really done is stay in this pretty wide range. So now you've got to assess what is the market maker doing in that range and who are they trying to induce into positions to trap before they eventually break out of this range and make their next big move. So that means we have to look just at this range and try to get a hint of what they're doing. And we do that by looking for the wicks. So remember what I said about point 3 of how the market maker induces a retail into a position? Point 3 was they issue stop hunts. So this week so far, you can see that we had this stop hunt high up here and then price just fell back away. We had another one here and price just fell back away. These are the perfect example when you see them in a range of how the market maker is trying to induce retail traders into a position. Let's really dive deep on this one right here. Prior to this candle happening, this was the high. Okay, so this right here would be resistance for most retail traders. Price came down, created a higher low compared to this low here, and then we came up, consolidated, and we moved. Now, as we got closer to where retail would have had their resistance, that's when they bought in the volume and moved it to the upside. Why do they do that? Because they know that there are things called breakout traders. Now, breakout traders wait for price to break a resistance or a support. Once it breaks the resistance, they open their position. So that means breakout traders here open their positions, or they may have had buy stops that just got automatically triggered, and immediately the price moves up, triggers their trades, and then it just comes straight back down before they have a chance to quickly exit. So this is why I don't like breakout trading. I think it's probably the worst strategy of all, but like, no offense to you if you're a breakout trader. I'm not like having a go at you, but you are intentionally being set up. And the same thing here. So price came down, created this support, broke up, comes all the way back. People who trade off support and resistance may have had limit orders at where they thought this support was, and bang, it comes down just enough to hit stop losses, and then it moves out to the upside. So all of this price action that has been happening this week has been intentional traps. The reason those intentional traps happen is because it's the only way that market makers can build their positions. They're not doing it to try and make sure you lose. Like, that's not the goal. This is just simply the way that they have to trade. So the difference is when you and I want to take a trade, we can just simply go to an exchange and we can enter the amount that we want to trade with. We put our stop loss and that's it. We enter it in, we press go, and that gets filled, and that's fine. But market makers are trading with much larger position sizes than us. They can't do the same thing because A, their whole position isn't going to get filled, and B, if they enter on like a market entry or something like that, it's going to spike the price and they end up with a bad average entries. So the only way market makers can fill their positions is by causing these moves that stop out retail traders, and then they get their positions from that. And so when we have a look at the current price action, that's essentially what's been happening really all week. And that's when myself as a day trader, I kind of go hands off because I can see what's happening, but I also understand that the bigger move is happening. So there's two ways you can trade this. If you're pretty sure on the direction of what's going to happen next, you can start to build positions every time you see it. Like, for example, if you were bearish, every time you saw these highs that just, rejected EMAs, like the 800 EMA on the 15-minute time frame has just been a beautiful resistance this week. You can slowly build short positions at each one of these and then just exit the trade if it becomes invalidated. The other thing you can do is just try to identify within the range who's the currently trapped trader. And the way you do that is you're looking for the last peak formation, high or low. And so when we have a look at this week, you only really need to look, 3 to 5 days back. But the last trapped trader was down here, okay? Because price spiked down into that low, and so far over a few days, we have not returned there. So if the price isn't returning there, it's because the market maker doesn't want to release these traders for some reason. The trapped traders would be traders that have gone short short here, short way too late. They don't have stop losses. They are hanging on to that trade because they don't want to get out in a loss. They think the price is going to come back and they're going to get out then. You know, that's what a trapped trader is. Someone's still learning how the markets work. Unfortunately, that makes you the number one target until you get good at this. So if you can see that price is not returning to a trapped trader zone, then you might become bullish in this scenario. The reason that they would keep traders trapped is because they need that liquidity. So if someone was short here, which there had to be in order for the candles to exist, then if they're short on leverage, they've got liquidation zones above price, depending on how much leverage they use. If it was 100x, they're already liquidated. 50x is probably already liquidated. 25 and 10x might still be hanging on. So if you can identify that the trap traders have not been released, that might cause you to actually become bullish from here. And this is why I'm starting to change my thesis of we're definitely just going down to 72 to we might actually go up first, maybe into the 90s. And then eventually, like in a few weeks' time, we come back down into the 70s. And so if that was your thinking, what you could do is at all of the spike lows, you slowly build long positions so that eventually when it breaks out, you're already in the trade and you don't have to worry about it. Now, the other thing that I will say about this price action, because I haven't done either of those two scenarios, by the way, I'm still just sitting on it and waiting. The other thing is this price action is not working. Okay. And the reason I say that is because the volume this week is atrocious. Okay. And that makes sense because of the fear that I showed you. We always have to, like I said, we have to build our evidence. We have to build our case. And sometimes you build that case of a lot more than just looking at a chart. So sentiment is low right now. People are in fear. It's not going to be that easy to get them to commit to trades. Again, when we come back and we have a look over here at the CVD, like when that's all dropping down, that's a disinterest, right? So you can see how they're inducing now. Like this here is rising only today. It's just started. This is rising because the price is having an attempted recovery and people are starting to get back involved in spot here. You know, this one's rising ahead of anything else. But in the price rising, it's liquidating futures positions and futures positions are not yet committed. This is stable. This is sideways. That's for coin margin contracts. And this is still heading down. So positions still being closed. Now that position being closed as price heading up could be people taking profit, which is good. That's a smart trader and they're not getting in trouble. But when you have a look at the chart alone, there's no volume in these candles. There's no fast moves. There's no, really large candles. There's nothing happening. And that means eventually we're going to have to get out of this range in order for people to get back involved and make a decision. Like I said, I'm included in this. I'm not in a position because I don't see anything that I currently like, but at some point the market maker is going to induce me into a position as well. So what needs to happen here? More so than just talking about price levels and price breaking out, what needs to happen is volume needs to come in and it needs to come in to break the range. Whilst it's in the range, if you really wanted to commit to a trade, and I'm not saying that this is good advice or not, I'm just telling you what the strategy would be for a seasoned trader who's okay with having some losses. A seasoned trader is probably going to be buying off the lows with low leverage and a decent stop loss, but they're probably also going to be opening a hedge position shorts at the highs, again with low leverage and a decent stop loss. One of those trades is not going to play out. One of them will. So the loss that they take on the one that doesn't play out should be made up by the one that does play out. Why I'm saying I'm not recommending you do that is because one other thing that the market maker can do, which I explained to you in step 1, is they can widen the range if the current range isn't working, which it's not right now. So I think we're at huge risk of the range getting widened because this range over 3 days has not been inducing traders. Now, why is that a problem? Let me give you the exact example. Let's just say you were one of those people that said, yeah, okay, Annie, that's what I'm going to do. I'm going to open a short position at the top of the range. And then when it goes down, into my 72K target, that's going to be a huge trade. And if that's wrong, because I can see the trap traders, I'm also going to open a long position every time we come down into the low lows. And I think that it will probably go up to the 90K. Well, we had shorts previously at 88, so we'll make that. So these are going to be my two trades, and one of them will lose when we eventually break out and one of them will win. Well, if the market maker needs to widen the range because this range isn't working, which we've established it's not working, then what they could do is break the range to the upside, say something like this, right? So let's just say the price continues to trend up and then they break it to the upside and they give us a wick here that is just a little bit higher than this one and a little bit higher than this one. What is that going to do? That's going to stop out your short position, right? It's also going to induce new breakout traders who have this as resistance. So now they've trapped new long positions, then they can send it down, okay? But your short position is already stopped out. And if they send this down fast, your long position, if you don't close it in time, also gets stopped out. So that's a very dangerous strategy unless you're an advanced trader and you're able to manage your positions really, really well. But that's what you're at high risk of right now because, like I said, we do have a high chance that the market maker may need to widen this range before we actually get the next real short-term good trading move. And that's simply because the candles are showing us that whatever they're trying to get us to do, we're not doing it yet. And that's a problem. Now, there's the thing about markets. It's all psychology and understanding, not just traditionally what candles teach you. You know, like if you go to learn technical analysis, they'll teach you, oh, a hammer has a body and then it has a wick. And a bullish engulfing is a big body that engulfs the candle. So like, that's not what you need to know about price action. None of that's what you need to know about price action. What you really need to learn about candles is what the market makers are doing when a candle makes a specific move. That's the kind of stuff that we teach at Trade Travel Chill in our courses. So if you are interested in learning all of this stuff in full so that you can make these decisions for yourself, consider getting a TTC membership. Our memberships include access to all of our courses. We have multiple live sessions per day. So it doesn't matter where you are in the world, there will be something that you can attend. And if you can't attend them live, we also record all of our sessions as well. Not to mention, memberships also include access to our Discord and our full team of traders where you can ask questions anytime. But really, this is really important for you to learn. When price is going sideways like this, the market maker is just waiting for you to guess the breakout so that you can commit to a trade. You don't have to guess it. If you learn what these candles are telling you, you don't have to guess it.